for this, Bill. You're a believer that tariffs don't actually raise inflation. I want to ask you, where are you getting that from now? We continue to see these economic reports, whether it's ISM manufacturing, a number of others, where prices are going up, inputs are going up as well. How do you not see tariffs causing inflation?
A lot of the tariff inflation talk really is based on surveys, and surveys are showing people's anxiety as more and more people talk about tariffs and how they might raise prices. Let's take a look at how big imports are relative to GDP. It's only 14% of GDP. So we're not talking a big chunk of GDP that's going to be affected by tariffs, even if they are large tariffs and very extensive tariffs. And then we now have tariffs putting recession calls up, and again, at 14% of GDP, that's not a big lever on which to hold back GDP growth. Now, the one thing that I would say is causing a lot of uncertainty out there is whether or not President Trump is really going to make his MAGA agenda a reality or not, or whether it's going to be delayed. That, I think, is a true source of uncertainty. But in terms of tariffs and the fact that the U.S. is a relatively closed economy, these are not the ingredients of high recession pressures or high inflation pressures.
You know, Bill, I really wish we had more time because, I mean, we're seeing tariffs. We're also seeing DOGE. So it feels like his MAGA agenda is already being put in place. But I really want to go to what we're actually certain about. We're certain that the auto tariffs are going to raise the cost of autos. In fact, some new numbers out from Cox, the tariffs could raise Canadian and Mexican-made vehicles by as much as $6,000. And it's especially going to hit lower-cost vehicles that impact lower-end consumers. So when we're getting this data right here, we're pretty certain this is going to raise cost, right, on a very important part of the economy, the auto sector.
Frank, how often do you buy a car? I mean, auto expenditures are only 3% of consumer expenditures overall. So it's not a big ticket. It's a big ticket item when you buy the car, but it's not a big chunk of consumption right now. We spend more on food, like and insurance and healthcare costs.
But those are higher too, Bill. But those are higher. Like pharmaceuticals would get higher if there's tariffs potentially. Food, we heard the Target CEO come out and say right away that the tariffs are going to raise the cost of food like almost immediately.
That's the source of inflation, right, that we have been worried about. The core inflation has been pushed up by the domestic services, not international services, not international goods. Now, Frank, if you're a tequila drinker or a big fan of avocados, I absolutely guarantee you your cost of living is going to go up. But most of us can switch from tequila to bourbon. So I think we have the possibility of switching from these high-cost imports to lower-cost domestically produced goods, and that's exactly what President Trump is trying to do.
Well, I got to say, tequila's a bad example because you can only get tequila from one place. So if you're a tequila drinker, you're not going to change. But that's an aside note, Bill. You might be revealing some of the things you like to do in your off time right there. I want to get back to something very serious. We saw over a month ago that University of Michigan consumer sentiment number, the 5-year outlook, led to a sell-off. We got another number that seems to really be concerning investors. The 5-year outlook, highest read since February of 1993 at 4.1%. So whether this is a survey or not a survey, the sentiment seems to be really spot on, Bill, is that people are pulling back on spending because they're worried about a slowdown in the economy and they're worried about rising prices, I should say. That's very real. So
no, that's soft data. The real data shows that consumer spending is slowing down, but not as much as people might expect, given those surveys. I think the source of real sentiment decline is that the Michigan survey is highly correlated with the stock market. And I think that's the feedback you're starting to see. And also the Conference Board survey is very correlated with the ability to get jobs easily. And that is getting more difficult because hiring has slowed down. So I think the other correlations that are messing up the soft data, and until we actually see the hard data start to react badly, I think you need to chill out a bit. And even the GDP numbers that the first quarter Atlanta Fed is projecting, if you take out gold anomalies, again, you'll see a flat first quarter, and that's with all of this anticipatory imports coming in. So we have a mechanical slowdown in GDP caused by a lot of imports, caused by the fact that people want to bring in imports sooner rather than later.
In all fairness, but we're not talking about GDP. We're talking about consumer sentiment, and we're hearing from a lot of companies. You can call that soft data if you want. A lot of companies saying the consumer is slowing down in real time. Reports, of course, are backwards looking. One last thing before we go, Bill, because we're out of time. Goldman raising its outlook for Fed cuts this year from 2 up to 3. Do you agree with that a slowdown in the economy is going to lead the Fed to cut?
If we get a serious slowdown and unemployment rate reaches above 4.5%, we will add an extra rate cut in there. But I don't think that's going to happen until into next year at best.